To my immediate right, next to me, as I said, we kind of have folks going throughout the food chain here. Right next to me is Jim Breyer of Accel Partners, also of Breyer Capital. Used to be a board member at Facebook, Walmart, Dell, and more. Next to him is Josh Kopelman, who we've seen kind of this explosion of seed funds and super angel funds. He is a co-founding partner of First Round Capital, arguably the first of that generation. And next to him is Jimmy Lee, who is chairman of JPMorgan, which I am told is an investment bank. Is that correct? That's what I've heard.
Dan, I flew a long way to get out here, okay?
Understood.
Some respect, okay?
Fair enough. As you all know, Jimmy is kind of involved. If JPMorgan is involved in a deal, and they usually are involved in a deal, Jimmy is very much in that, whether that be big M&A, big IPOs, such as the Alibaba one, which theoretically is coming up soon, which he probably will not be able to talk about today. Jim, let me start with you. This past quarter on venture capital was the most venture capital invested in any quarter since Q2 of 2001. And we all kind of know what happened after the second quarter of 2001. You were quoted a couple of years ago. You said this. You said, when you start paying attention, I'm sorry. When you start paying attention, I've screwed this up completely.
I'm ready.
I've completely screwed this up. Here it is. When pessimism is high, get out. When pessimism is low, get in. I'm screwing this up completely. Let me say it this way. Should you be investing now as a venture capitalist? Is this a good time, or is this 2001 over?
Well, I don't know if it's 2001, and it's always hard to make generalizations about where we are in the playing field. But when pessimism is high, that tends to be a terrific time to invest. When optimism is off the charts, it's time to take some dollars off the table, move on. Can't predict long-term markets, but it sure pays to know where we are in the playing field.
Does it concern you at all when you're investing? And obviously, every deal you do is specific to a company, and it's a specific opportunity. But when you look, do you start to say, you know what, there's too much money out here right now. This is a time I should be pulling back, or at least being a lot more selective about the deals I'm doing?
Well, we always try to be selective. That's not, in retrospect,
more selective?
True. We've made our fair share of mistakes. I think when the markets are this positive globally, whether it's China, as Jimmy, you and I spoke about, whether it's consumer internet, whether it's big data, cloud, these are 10x, 20x like opportunities in the venture capital business over 5 years for new deals. But I do worry that there is a sheer abundance of capital worldwide that gives me great pause for concern.
Josh, the argument you hear a lot from venture capitalists when you throw kind of the general numbers is, the response is, particularly compared to 2001, look, this isn't like then. These are real companies with real business models, whether that be on the consumer side and say on the advertising side, or clearly, as Jim said, cloud-based SaaS models, et cetera. Do you feel that's right? Is that a legitimate argument, or is that just trying to rationalize bad behavior?
No, I think it's pretty legitimate. When you look at the stage of companies and the number of, and the size and scale of revenues, of customers, and the world is so different. When you look at how many internet users there are, how many mobile users there are, I believe that you're seeing companies actually exercise discipline in waiting to go public longer, which is creating more opportunities for investment in private companies.
Jimmy, you mentioned to me last year, you guys participated in the so-called SPL, kind of a debt deal for Jawbone.
Right.
And at the time you mentioned that you had written off is the wrong word because you didn't say that, but you weren't paying necessarily as much attention to a lot of the startups in Silicon Valley because obviously you're later in the food chain, but you also remembered the dot-com bust a lot. What kind of changed your mind, or correct me if I'm wrong about this, but kind of made you more interested in what was happening at the Valley at the earlier stages rather than where you normally play?
Yeah, I mean, it's a great question, and Jim is sort of part of the story, but I remember my first meeting with Facebook. I'm going to say it must have been like 5 years ago, maybe a little bit longer, more or less. And I remember sitting there talking to David Ebersman and Cheryl, and I remember calling Jamie when I left the meeting, and I said, there is something new that's going on out here. These companies are being built to last. They have really experienced professionals running them. They are building fortress balance sheets. And I said, I just think this is going to be a wonderful time for JPMorgan here because of this attitude, because we love management teams that want to build businesses forever. And so that was what kind of clicked it over for me. And Jim and I have talked about this many times, and it's very, very exciting because these companies can withstand the storm. So you were talking about money before, and there's so much money. You can't get distracted by either too much money or too little money. You just have to build the company to withstand the storm. You don't know when it's going to come, you just know it's going to come.
Do you think when you look back, and not necessarily the deals you guys have been involved in, you mentioned IPOs, do you think that most of the tech IPOs companies that we've seen, say, come out maybe in the last 18, 24 months, do you think most of those are in shape to survive the storm if and when the storm comes? I know I'm asking for a generalization, but.
I think the big companies are being built that way, and if the IPO is done right, and you know, the IPO is an interesting event. We were also talking about this. So the typical banker on the typical IPO wants to tell management, you know, you're handsome, you're beautiful, you're spectacular, your company's amazing, you're awesome, you're epic.
Keep going, Jimmy.
All of which may in fact be true. And what happens is you can get this sort of momentum that looks positive, but then can be negative, because the risks on the IPO are super asymmetrical. So if you price the deal too high and the stock falls out of bed, management's unhappy, the employees are unhappy, the shareholders are unhappy, and you just don't know how long it's going to take. And by the way, you can damage the brand. You price the IPO too low, you can still increase the size of the deal, increase the price of the deal, and so on and so forth, and still get the deal done. And so I think it's important to get these kinds of things correct and really protect the company, the brand, the employees as you do the deal.
Jim, you were involved in one that arguably ticked at the top in terms of pricing on the IPO. How do you view that? You know,
Which one was that?
I think it's a social network of sorts. When you're looking at it, there's some people suggest, you know, we should try to get, we being the issuer, we should try to get almost every dollar. That's the money that's going into our bank accounts. That's our money. That 15%, if there's a pop, that's for the bank's clients. That doesn't help us. That helps the bank's clients. How do you view that as an investor, as a board member of a private company that's going public?
Well, it's, for me, very similar to a venture capital event. When the entrepreneurs in the audience and around the world are raising money, valuation matters. And a public offering or a secondary offering after the public offering is no different. There's dilution. It's cash in the bank for the companies that are raising money. It's much less a marketing event than it is a significant step along the long-term financial event. And so as a board member, investor, someone who cares deeply about these companies, we'll negotiate hard with the entrepreneurs.
What's your target? What's your idea? If you say you're negotiating, but how much, I guess I'll ask it this way. If you've got a company, how much pop do you want on the first day? How much pop do you want in the first couple months?
In a perfect world,
obviously you want a lot of pop, but
actually,
how much first day?
No, if it's a significant float, and so we're raising hundreds of millions or billions of dollars in a public offering, what I would advise management to do is hope for a 10 or 20% pop, quote unquote. 6 months later, a year later, 2 years later, we hope it's trading 50 to 100% higher. But a 100% pop, to me, is leaving a lot of money on the table where the company can use that cash and put it on its balance sheet. One person's view.
The one flip, of course, of that is when that happens, when that 100% pop happens, even if the company priced very low to get to that, the headlines are all extraordinary, right? Headline, company doubles in value on the first day. There is a reputational value, or Jimmy, to what you said, is that even though there's good headlines for the company, does the company brand ultimately suffer from that?
Well, that's why I say the risk is asymmetric, right? So, in other words, if you get it wrong, it can really hurt the company. Wrong meaning like the stock goes straight down. You asked about day one. I think day one's an important day, and I think you have to really think about what do you want at 4 p.m. EST on day one. And I remember working for the US government when we took General Motors public. And US Treasury had a very specific view on where they wanted those shares to trade on day one, and we sort of managed to that outcome. And I think Jim's exactly right. If you really think that through and try to manage to that outcome, you're ultimately going to get it right. My point is the asymmetry comes is if you price it way too high, and for whatever reason, some of these companies are fragile, and the market doesn't like the deal, the stock falls out of bed on day one. Now you've got all this negative karma around the transaction and the company, and is that really a good thing?
Josh, let me ask you, because you're obviously on the earlier stages. You guys usually, and correct me if I'm wrong, usually get off the board after 2 years.
Yep.
Good company, bad company. I wonder for you, how often do you try to take some money off the table before the IPO? Because if you're getting kind of out and you're not on the board anymore, do you kind of get worried about what happens in the later stage to even some of your better companies that you're not necessarily around the table when these decisions are being made?
So we pretty rarely take money off the table, but our general philosophy is we like to be aligned with the founders. We see ourselves coming in right after the founders, and we're the closest to the founders in the cap table. So if the founders are in it for the long haul, so are we.
For you, Josh, one other question for you, and I want to talk valuation a little bit. Jimmy, you talked about a lot of money in the market. There's been a lot of talk, is there a bubble, is there not? That's been talked about probably at this conference for 3 years, and at every tech conference for probably 3, maybe 4 years. So let me ask you, I guess, a different way. Josh, I'll start with you. Has your investment, not strategy changed, but has your investment discipline changed over the last couple of years? In other words, if you used to walk away a lot faster, do you walk away a little slower now when it comes to price?
Great.
Basically, you're
So
willing to pay whatever it takes.
You want me on video talking about that I'm not price sensitive. Yeah, to raise the chair, what do you do? Yeah, look, in general, as you've seen more capital go into the seed market, you've seen prices go up. I think prices have gone up in seed stage deals. We've seen them gone up 20, 30% in the last few years alone, which matters for a seed stage investor. It might not matter for a later stage investor, but if you invest at a 5 million pre versus a 10 million pre, the difference there is you're giving up 50% of your upside, assuming that the company doesn't exit for twice as much. So basically, the day you write that check, your return is cut in half. So have we tried to maintain some price sensitivity? Yes, but you're also talking to a venture capitalist who passed on Twitter and Dropbox due to price. So now we recovered when it came to Square, and we paid that high price, and we're very happy we did. But yeah, I'd say in general, we're players in a market, and we need to look at any point in time at where the market value is, and if the market value is moving north, we need to assess that. So obviously, company by company.
Jim, for you as well, a similar question. You're usually a little bit later in the food chain, but not always. Have you changed? I remember it seemed to be that venture capitalists would walk a lot more, say, this is our price, maybe we're willing to go in our minds, we're willing to go maybe 10% higher if that's where the negotiation goes, and then we're done. Because ultimately, it's stick to your knitting, we have to explain to our LPs. But on the other hand, you don't want to walk away from, say, Uber over a couple $1 million pre-money and then regret it later. Do you think you personally are you more willing to negotiate on price than you used to be?
Well, I think there are a couple meetings, couple deals a year where the entrepreneurs and the founding team is so good that what I will say to myself, and history is reflective, just want to be in business with this team in person for the next decade. And so I'll cave on price. Simple as that. You can't do that across the portfolio. If we're doing 12 new deals in the US per year, if we're doing 12 new deals in China per year, et cetera, there has to be overall portfolio discipline. But for sure, many of our best deals, many of my best deals when I think back on 20 plus years, if it's 50 or 100x, in almost every one of those cases, I caved on price. That will never change. For the early stage Series A, Series B, for the great deals, for the great entrepreneurs who have
Did you cave on price on
something
Facebook?
Completely.
How much lower did you want to go?
Oh, I would have loved to have.
Well, don't say like $1, but like how much lower realistically did you want to go?
We paid 78 pre-money. I shook hands with Mark on a Thursday. I knew there was a chance to maybe get 70 pre, but I was optimizing for ownership, and I knew that I needed to cave to get the deal.
Fair enough.
Simple
See,
as that.
that's the point that I'm making. That's so different. When you get someone like Jim, who's making this distinction on a transaction, this is this built to last, great management teams. You can't let the IPO define the company, define the brand, define the vision. That's what the management team does. The IPO is a sale of securities. That's all it is. And by the way, almost all the time, it's only around 15% of the entire company. So everyone still owns 85 cents.
Jimmy, we've seen with some of the better privately held companies, slightly older privately held companies, this kind of influx of hedge fund, mutual fund money. There's always been later stage VCs, but we're now seeing a lot of kind of less traditional money coming in pre-IPO rounds, big rounds, sometimes with liquidity, sometimes not. I'm curious, broader market question, is that good for the market? Should a company like an Uber wait until it's a $30 billion company instead of saying, you know what, we're valued higher than Hertz, we could go public today.
Right.
Just from the market as a whole in the tech market, do you think it's better for companies to keep waiting until they can't wait any longer?
Well, it's a good question, which is why we designed the SPL, which is a security that we designed. I need a better marketing, so
yeah, I didn't
you guys
mean to tee
come
that
up
up
with
so well.
something that's catchier than SPL, which means staying private longer. It's really just a mezzanine security. But you know, it's a great question. I think it probably varies from company to company. I don't think that some companies, I think, are better off waiting and building and getting a bigger, broader, deeper team, maybe being more global, having a killer fortress balance sheet. Other companies might be better off, you know, going earlier than that. I mean, one thing that I noticed was there were no securities that were in between Josh and Jim and a bank loan, for example, or Josh and Jim and an IPO. There was nothing else. There's only just a few choices.
Yeah, we're seeing the money run to the edges, right? You're seeing a lot of capital going in late stage and a lot of capital going in early stage. I actually think the Series A round is probably the most ignored portion of the venture ecosystem right now.
If you were starting a new firm, is that what you do, a Series A fund?
If someone told me I could not work at first round today and I had to start a new firm, I would start there, because you're seeing a 4 to 5x increase in seed rounds happening. It's like, imagine if you're a Stanford University and you have 5x the number of applicants coming in any given year. You could field 5 classes that have the same exact SAT scores and the same, you know, have just as many valedictorians, but you have a certain amount of seats in the class because Series A rounds have not, the capital going to Series A has not gone up. So, you know, so you're, as a byproduct, you're seeing seed rounds get larger.
Yep.
because companies know they need to raise more to actually demonstrate traction. So the Series A round is the hardest round to raise, and I think it's probably the most ignored opportunity in the venture landscape right now.
I wonder, you know, you talked about kind of the explosion of seed stage funding, and it's kind of jumping around a bit, but kind of where's the valuation jump coming? From your perspective, are valuations seed stage companies rising because there's a lot of money there, so people are competing for the same deals? Or is it a trickle down because the IPOs are higher priced, the late stage rounds are higher priced, and the valuation trickles down?
I think primarily, in my view, it's primarily due to access to capital. There's a lot more capital. You have great tools like AngelList, which are democratizing investing, Funders Club, things like that. And you're seeing a lot more capital just paying attention to this space. The average initial investment of the venture industry years ago, the Series A investment was $6 million. Now you're seeing companies get off the ground with 600,000.
Jim, I'm wondering, when it comes to these later stage investments and the kind of staying private longer, whether that is via mezzanine sort of round or a kind of, well, a traditional, you know, billion-dollar Series E round, is there any worry that there's going to be orphans? In other words, that you're going to have a company that said, we're going to keep taking private money and we'll go public next year, we'll go public in 2 years or 3 years, and then if the bull markets kind of slow down and those hedge funds and mutual funds run away from the market, who funds that company for that next round if there's not a good IPO window for them?
I would hope they're raising enough money so they're cash flow positive in perpetuity. But there are segments that change very quickly. And I think Josh and Jimmy raise excellent points. If we take something like digital currency and Bitcoin,
yep.
There is a shortage, in my view, of great digital currency companies. Because I do believe 5 years from now, there will be a handful, a dozen, that are trading at $5 to $10 billion.
Will Circle be one of those?
I sure hope so, but
just checking.
On the industry itself, if I was a 25-year-old entrepreneur, digital currency on a global basis, there are cloud-based services, there are new companies built in messaging around cybersecurity that are secure, that are global from day one, they are built on new architectures. This is why there's so much money at the top of the funnel. The opportunities are better than ever, but we all know there will be sadness around capital markets. There will be corrections. Chinese companies, particularly around the consumer internet, are brutally competitive and extremely good. And so we have global competition now where having tens of millions, if not hundreds of millions of dollars of extra cash on the balance sheet is a really smart thing to do.
It's off topic, but I'm going to quickly ask, do you for both of you, I guess, do you agree that in whatever it is, 5 years, we're going to have a couple multi-billion-dollar digital currency companies, whether that currency be Bitcoin or something else?
Yes.
You do? Jimmy, do you?
I don't know. We think about Bitcoin a lot, as you can imagine, right?
Yeah.
I just don't know.
I would take every bet in the room, whether it's Bitcoin or a digital currency. 5 to 10 years from now, I will make that
I'd also add
bet every day. There will be at least half a dozen digital currency companies that are being formed today or within the last 6 months that are worth well north of $1 billion 5 years from now.
The blockchain also is part of that, right? It might not even be a digital currency.
Somebody's long digital currency.
Yeah, he's got some.
5 to 10 years, absolutely. The transaction costs, the
talking his book right now.
innovation, for sure.
You're long, dude.
I am long digital currency.
Before going to Q&A with the audience, let's talk. We've talked a lot about IPO, but the vast majority of venture-backed companies, private companies who are successful don't go the IPO route. They go the M&A route. You know, in the beginning of 2012, there was tons of stories. I'm sure I wrote one which suggested public companies have tons of cash on the balance sheet. The public markets are doing well, so companies theoretically might be willing to sell. Their stock prices are high. And then we didn't see a huge amount of M&A, at least relatively speaking. And then same stories got written at the beginning of 2012, or 2013. Same thing happened. This seems to be the year where it's all finally come together. The numbers, not just for tech, but across industry, are extremely high for M&A. Jimmy, what's different now? Why is this happening now as opposed to a year ago?
Well, it's always hard to predict exactly when a market turns, right? Predicting a bottom and a top in any asset class is virtually impossible, and you don't really need to. You just need to be kind of close, as Warren Buffett would say. It has been building. The balance sheets have been building. The cost of capital is almost, virtually zero, and confidence has been building in these companies. And one thing that started last year, but it wasn't noticed by many people, was acquirers' stocks started going up at announcement. These were not gigantic transactions, but we, of course, noticed them. And so the buy side was saying, okay, guys, we're going to pay for growth. It's okay that you paid a 30% premium. It's okay. We still love the fact that you're buying growth. And so I think a lot of it is very much sort of a growth challenge that companies now want to go after and attack hard. And I remember saying last year, I thought it would be big this year in the Valley, and I think it's going to get even bigger. Some of these companies have done such great jobs, Facebook and Instagram, Google and YouTube. I think they now feel very comfortable they can, participate in an M&A big move and make it work incredibly well.
What was your gut reaction when you saw the WhatsApp price?
I thought that, look, that management team is, I think, one of the best management teams I've ever come across in my entire career.
The Facebook team you're talking about?
Yes. Starting with the board. You're no longer on the board, so this is not like a cheerio to him. But he's an unbelievable director. I just think, what you want to do is you want to find teams and you want to back them. That's the job of a banker. It's not to decide, should you buy WhatsApp or should you buy something else? Because as a banker, you don't know, but hopefully that management team does know. So I had no reaction other than I was happy to see the team make a big, bold move.
Josh, when I say we, do I mean in the media, do you feel as a VC, you guys can do very well, and probably you obviously have Uber and some these outliers, but most of the real returns you guys generate are for sub-billion-dollar exits, but you can still obviously make very good money on them. Do you feel that we being the press, do we focus way too much on the so-called unicorns and not enough on the other ones? And I guess I mean that in the sense of, even when you guys are trying to raise funds from LPs, do LPs focus on the big ones and they don't so much focus on the nice 10x, 200 million return?
Yeah, but I think that in general, when you look, so we built our fund model, for example, I could just speak for myself. We built our fund model so that we could generate strong returns for our limited partners without relying on unicorns to drive that. That said, when you have a company like an Uber, an Airbnb, a LinkedIn, or something in that portfolio, that's what drives sort of the epic fund returns, and that's what sort of captures and fascinates the attention of both the limited partners, but also entrepreneurs. Because when entrepreneurs are starting companies and where they're thinking about becoming a company, those are the types of companies that they want to build. They want to build that next the defining company of the next generation.
Fair enough. We've got some time for some questions, if we have them. I've got a lot of lights in my eyes, so raise your hand and there will be somebody with a mic who comes to you.
Thanks. Yeah, question for Josh and Jim. My name's Sunil. I'm from Scripted.com. You guys have made some big bets on labor marketplace companies, very successful bets over the last few years. You have 90 million Americans that have dropped out of the workforce that are piecing together incomes through Uber, through 99 Designs and others. Yep. What kind of risk do you see for freelance labor in this country unionizing over the next decade?
Josh, after you.
So we have a pretty big thesis that we're seeing a pretty big shift from the W-2 to the 1099. That you're seeing a big shift in the macro workforce from full-time to independent, whether that's Uber or TaskRabbit or Dog Vacay or Urban Sitter. Regarding unionization, we have not yet seen that, and a large part of this comes down to, do these platforms, what is the nature of the relationship between the platform and their vendors? Uber has reportedly said they're adding 20,000 drivers a month, and yet we have not yet seen any of that from an investment perspective. It doesn't drive our thesis.
And I would say, from a Silicon Valley and Cambridge, Massachusetts, and Brooklyn, New York, Etsy perspective, when I think back, the number of wonderful jobs that are created within small businesses today by a lot of the current and next generation internet companies is really exciting. And I view the job growth in these ecosystems as very significant, and I believe that it will continue worldwide. I don't know how the politics will play out, but I sure do feel that there are a lot of 1-, and 2-, and 3-person companies that are building great businesses on top of the current curated internet, mobile, and social platforms that will continue to thrive, and it's very exciting.
Mark Mahaney at RBC. One of the biggest changes, Dan, you alluded to this in your question, since the first bubble, or since the bubble, was the rise of these mega cap names. There are almost a dozen of these names with massive amounts of equity and cash. Do you, Josh and Jim, do you see them directly competing with you? Has that changed the perception for you? And then could you comment on interest in private companies, your portfolio companies, and going public exits? It's waxed and waned over the years. What are we doing now? Are we waxing or waning? Thanks.
Well, I think the best internet large cap companies, Google, Apple, Amazon, others, absolutely are competing very effectively in the venture capital business. They are partners in some companies. They deeply compete in others. They're really good. And globally, we see Tencent, Baidu, Alibaba becoming far more competitive. So I do think the venture capital business is a business where there are increased competitive risks, largely from the very, very strong, large media and internet companies worldwide. Simple as that.
Stephen Wolf Pereira from Datalogics. I'm curious for the panel, what do you think is the most overhyped kind of technology buzzword and the most underhyped?
Jimmy, what do you think?
I'm not going there. I don't know.
So the most underhyped is Bitcoin.
There you go.
Really? Were you not listening for the last 10 minutes?
Digital currency, underhyped.
All right, so what's
underhyped?
What's the
We'll
most
shake
overhyped?
on that.
What's the most overhyped?
I don't know. You have anything?
Well, I think that
You're both thinking through your portfolios, thinking who you're
Who am I going to piss off?
when there's substance. So I do think the companies that are sitting at the intersection and can't be squarely put in a certain segment. So next generation data companies that are applying their technologies to media, to healthcare to the energy grid, these are underhyped companies because they're applying big data and technologies to traditional industries that I think will be and should be under attack.
Yeah, and I'll take a page out of that book a little bit. Have you thought about Bitcoin or? No. No,
digital currency.
So one thing that we're keeping an eye on at the moment is really the combination of distribution and content and how that sort of waxes and wanes over time. Sometimes content is king, sometimes it's not. I think right now it's clearly king. And Comcast acquiring NBC some time ago, I think that has application actually to this present environment and some of these very large internet companies that you could argue are vast distribution networks. And what does that mean for the intersection, to use Jim's word, of content and distribution? I do think that I think that's pretty hyped, using your phrase.
Fair enough. Guys, I really want to thank you. That's all the time we have. Thank you very much for coming to Aspen and doing this with us. Appreciate it.